So we're on the brink of a government shutdown within hours. And the question I have is, how in the world did mortgage rates go down? And actually the stock market, well, the Dow Jones and the S&P 500 hit record highs. The question I have for today is, why isn't the markets phased by a government shutdown? Because if you're watching this video, most likely you're trying to figure out what's going on with those and the whys behind it. So today, hopefully I can answer that question for you. So without further ado, let's get to today's news. What we saw in the markets right now is mortgage rates came down just a tick, but the equity indices just hit record highs. Why isn't the market just saying, okay, the government's going to be shut down, everything's going to stop? You would think the markets would crash, right? Well, no. Here's actually what happens, and here's why the markets aren't really phased by a lot of this data. If you really dive into it, the reasons why they weren't phased, we're going to go through a couple topic points here, is one, we faced it in the past. In 2013, we went through a government shutdown. In 2018 to 2019, we also had a government shutdown. And in most cases, it was short-lived. It wasn't even, I don't even think the longest one lasted 30 days. Investors see shutdown as temporary, and it's basically political theater. That's what the markets are looking at. If you look at the economy, well, basically most of the stuff is going to get funded. Benefits, military, debt payments, they'll all continue. It'll get rid of unnecessary workers. I'm not saying that. That's how it comes across through here. They're saying, they're going to keep the necessary workers still working, but those that they can furlough, they're going to be furloughed. So if you're a contractor for the government, you're probably going to see no paychecks for a while. Let me get my head out of the way so you can see the rest of these things. Bigger drivers dominate. Fed policies, we know the Federal Reserve is in rate cut mode. Inflation, that's still up in the air, how inflation is going to go. But even Federal Chairman Powell said last time, the inflation, it will have a one-time uptick because of the tariffs, but it won't be a long trend. They're expecting in 2026 to 2027 to get back to their inflation 2.0 number. Earnings, they're still coming in and they're robust. So the markets are saying earnings are good, Fed's cutting, and inflation's still not too bad. The markets are still running like doesn't really care the markets are shut down. Rate cuts are expected, and that's overshadowing short-term political noise. Priced in, a lot of this was already priced in, a lot of people were saying, and it's also priced in for short-term durations. Now, the longer this thing goes, the worse it's going to get. So here's what could happen or what could change the market's mind. Well, an extended period of time in a government shutdown, it will start to cause havoc, because even I was doing this years ago in 2018, 2019, and FHA loans were kind of slowed down. VA loans had no issues. USDA loans couldn't be done, but the markets still were able to get things done. So we're going to see, some slowdowns in some areas of the markets, but extended shutdown will cause some effects. Data blackouts. Here's the biggest problem we have. We won't probably be giving you a lot of economic news going forward until this is resolved, because we're not going to get the news, such as the unemployment rate that we were hoping to get this week. Negative earnings revisions tied to delay permits, payments, and demands. So that's some of the things that we're going to look at. Here's what you really have to pay attention to. Here's our playbook, okay? The context of what we're looking at right now is shutdown equals debt defaults. Essential payments will continue. Okay, watch the Fed's path, watch earnings, and watch lead indicators, such as, we're not going to get a lot of lead indicators throughout, but as a lot of the reports come in, this is what we're going to have to focus in on. What the Federal Reserve's telling us, they're going to be continuing to talk and do interviews. We're going to continue to watch earnings reports, and then there will be some leading indicators that we will have access to, and I'll provide those with you here. The problem is, the longer it lasts, the more uncertainties we have and the more confusion the markets are going to have, and the markets don't like uncertainty. So that's going to play a bigger role as this looms, as the government shutdowns looms. Data, if jobs and CPI are delayed, what's the Federal Reserve going to make a decision on? That's the biggest problem the markets face right now. But the good news is prior shutdowns, they were brief and we had quick recoveries. So that's basically why the markets right now are doing what they're doing. We have mortgage rates not doing that well or not doing that bad today. We also have the stock market. Let's go over and see what the markets are doing for the closing bell today. See where it ended up. And we should have green across the board, hopefully. Let's get it. We got it. So we have green all the way across the board. We got the VIX up just a little bit, up to 16. That's not really anything to be concerned about. That gives us the anxiety level on Wall Street. Let's see what oil's doing. Oil is down. If we could have a trifecta here with crypto, We got it, folks. So here's what I talk about when I talked about the trifecta. We got the indices right through here, all the way across the board up. That is good news. We have the VIX. Well, we don't focus in on that. We got oil down, and we got crypto up. So fantastic news across the board through there. Let's get over to some of the news that we really want to focus in on. Now, this might be the last piece of data we have on the jobs report. Now, this is the JOLT index that came out this morning. It's job openings and labor transfers. Rick, buddy, this might be the last time I see in a couple weeks. So do your justice for us today and explain to us the economic news that came out for today and how those will be affecting these over through here, my friend. So, Rick, take it away for me, buddy.
Conference board and JOLTS on the tape as well. Let's get to Rick Santelli again. Hey, Rick.
Yes, on JOLTS, this is an August read. Openings expected to be right around 7.2 million. A little bit extra horsepower, 7,227,000. That'll be the best number since, well, just June. But in the rearview mirror, a nice upward revision. Last month, originally reported 7,181,000, becomes 7,208,000. And it's significant because that now changes the dynamics. That would have been last month, July, the weakest of the year. Moving it to 7,208,000 makes it the second weakest. The big number month now is March at 7,200,000, the lowest job openings of the year. If we look at Conference Board, these are September confidence numbers, and boy, they're disappointing. If we look at the headline, well below expectations at 94.2, the weakest since April of this year, sequentially lower, even though there was subtle positive revisions to all three metrics last month. If we look at the present situation, another big disappointment, 125.4, the weakest since September of 2024, well below 132.4 in the rearview mirror for our August final. And finally, expectations at 73.4. That is the weakest since June of this year and much sequentially lower, of course, than 74.7. So confidence disappoints, positive revision, and a better JOLTS number on the openings. We made the low yield of the session in Treasuries on those data points. That's coming in right around 410 plus on a 10-year. Sarah, back to you.
Okay, keep that for note. 410 on the Treasury this morning when he posted that. Where did we end for the day? 4.15. That's why you're seeing, well, you might get a revision on mortgage rates here soon because we got it down 0.01 for the day. But if you look at the bond market right now, we have the MBS down 6 ticks. And we also have Treasuries, a 10-year Treasury up from 4.11 to 4.15. Not a big move, but it's a big enough move that should have caused mortgage rates maybe to pop just a little bit today. So nothing really crazy out there. Let's go over the economic calendar to just recap some of these things. So here's what we had for today. We had the Chicago PMI. It actually came in at 40, just a little bit below where it was previously, way below where it was expected. Consumer confidence, like I said, this was going to be cracking. So I figured that was going to come in, but we did get a good JOLTS index. So now what's expected is hopefully we can get some of these numbers tomorrow, but we will come back with tomorrow's ADP payroll number to at least give you some insight on this. But I really don't like this number. We follow it because it's on the Bloomberg economic calendar, but they are so off most of the time that we really don't put much weight on those, and I don't think the markets do at this time either. So the concern now is we're looking for readings for the rest of this week on the jobs reports and earnings, people's earnings, and we're not going to get that. So the Federal Reserve right now is going to be flying blind for just a little bit of time. So pay attention with a lot of the earnings reports that are coming out. Pay attention to the 10-year Treasury and any other data that we can provide. I'll be giving it to you live each day to make sure you're staying abreast of where things are going from here. So if we go over to the bond market, like I said, MBSs are down 6 ticks. If you're new to my channel, let me just explain this for you real quick. We follow on this channel are mortgage rates, obviously, because it's the rate update. But when we come here each day, I show you this thing. So it really doesn't look like a rate because there's 100.80 up there. So how do you figure out what mortgage rates are doing based on this chart right through here? Well, this is a mortgage bond that trades on Wall Street, which you have to understand is kind of how this bond works and mostly all the other bonds. If the price of the bond, like you're seeing today, is going down, well, that means rates are going up. Well, since this is a mortgage bond, well, that means mortgage rates are going up. So we don't like when this is going down. We like when it's going up. But .06 isn't really going to move the pendulum at all. So mortgage rates are basically flat on the day. 10-year treasuries were up just a little bit. But if you go to the FedWatch tool, this is telling us in 28 days what the Federal Reserve is going to do. I got some more good news for you. This number keeps moving in a good direction. So if you look at probability, go down through here, there is a 96% chance now that the Federal Reserve will be cutting rates at the next meeting. But as you guys know, even though the Federal Reserve cuts rates, doesn't mean mortgage rates are going to go lower. So to understand how mortgage rates function, how they operate and where they change and what they do each day, please visit me each day so I can explain to you what's going on with these and the whys behind it. So folks, my name is Dan Frio. I do this report each day to inform you guys of all that. If you want to find out more about me and my team, just visit us at therateupdate.com. Here's our website. If you'd like to reach out to us, because we have a slogan, that slogan is one application, one credit pool. We're going to compare your loan to over 30 different lenders. How do we do that? Well, check out our event that we're going to have tomorrow. It's a live event. We're going to show you exactly how we do that. But just to answer any questions that you have, I'm licensed in all 50 states as well as Puerto Rico, so I'd love to be able to work with you, put my 30 years of experience to work for you. If you're looking to buy or refinance, we'd love to help. So thanks for watching. Join us tomorrow live at 2 o'clock, where me and Alan's going to show you how we do just that. The one application, one credit pool, and we're going to compare your loan to over 30 different lenders. Join us tomorrow, but otherwise have a fantastic evening. Be safe out there and take care of yourself, folks. And I can't wait to see you back tomorrow morning at our opening bell to see how this all starts another day. Take care, folks. See you then. Bye-bye.